All right, my friends, year-end tax planning. This is where it gets fun. This is the best time to be a financial advisor right here. I cannot wait to go over this with you. Oh, it's going to be fun. We got lots going on. So what is it today, November 18th or 17th or something like that. 31 December is coming up quickly. You better be prepared. You better be thinking about stuff because if you're not, you're leaving money on the table. So don't forget to subscribe down below. We're going to give you a couple of series on year-end tax planning, year-end financial planning, maybe is a better term, but either way. So don't forget to subscribe, thumbs up, comments. I'd love to hear your thoughts on this too. So, all right, let's just say I got a call from someone in California yesterday, and she's like, Josh, your videos are the best, blah, blah, blah. I'm like, yeah, that's great, thank you. And then we get to talking, and she goes, look, at the end of the day, we want to retire next year. I said, okay. Or maybe 2 years, just however the financial planning works out. We want to retire soon because my husband's 67. He started taking Social Security back in January, and I'm about to turn 61. And I want to be there for him because he's 6 years ahead of me, and I don't want him to die while I was still working when we can't have a good time to spend together. I said, absolutely. Enjoy it while you can because someone's going to die soon, most likely the man, especially a 6-year-older man. And when he dies, and you're going to be like, well, what do I do now? So we want to enjoy it while we can. All right, so we get to chatting, and we wonder if there's things we can do from a tax/financial planning projection before the year end. So a couple things going on here, and I'll save this for a second video, is that she had asked, actually, is it worth it to basically send the money back to Social Security that he received? So again, he took it out in January. Can he send it back, not suspend, pay back, withdraw the application? That's what it's called, to withdraw the application. And again, I'll do a video specific on that. The answer is absolutely. So if you take Social Security too early and it turns out you took it too early, you can do one of two things. You can withdraw your application as long as it's within the first 12 months. And that way you got to send the money back you received from Social Security. So in this case, it's about $30,000. So he's going to send them a check for $30,000 and just be done with it. And then we'll revisit that when he's 70 years old. That's called withdrawal. If it's after the first 12 months, you can't withdraw. You got to suspend your benefit. So you don't send the check back to Social Security. Essentially, you took 1 year of benefit, but you're suspending it, they're out. And that's still a wonderful thing to do because you're going to get those 8% year-over-year delayed earnings credits, especially if we're doing some tax planning here, which we're going to be. And we're going to start it this year, absolutely. So let's dive right into it. Oh, I need my thing here. So, all right, so we got year-end tax planning. And the first thing we're going to do, the very first thing, is because cash flow, my friends, is always king. All right, so what we're going to do here is we're going to say, how much money are you making as an income stream? And again, we're going to say no Social Security because the husband's going to send that money back. And so she's making, I think she said 75,000, I think maybe 75,000. Now she's 61. We'll call her Jane. Bob, he is 67. All right. So the first thing that jumps out at you there? What jumps out at you there? The very first thing, given their age. Well, they're going to have one excess standard deduction for Bob, $13,300, and then one $12,000 standard deduction for her. All right. So that's the first thing that jumps out. So their standard deductions are $23,300. Now, they did put money away. She put the max into her 401k. So we're going to have, actually, I need to reduce that now I think about it. Because I think she said she did 18,000. I think is what she did. The max, she didn't do the full max. I think she said 18. We're going to go with $18,000 she deferred into her 401k. All right, so what does that give us? $57,000, right? Minus $25,300 in standard deductions. All right, so I think that's what it was. She made $75,000. She put $18,000, not quite the max, but a pretty significant amount of money. Let's just make sure my math is right there. And that leaves them with a just gross income of $57,000. We got 75 minus 18. Yeah, $57,000. Subtract 57,000 minus 25,300. $31,700 is their taxable income. All right, so that's their tax income. All right. Man, I just love this stuff. How much more before they hit the 22% bracket? Want to take a guess? Now, off the top of my head, I don't remember exactly. I think that the 12% bracket, it goes 0, and I'm just going to say 0 to 19.5 is 10. 19.5 to 77,800, I think, and don't quote me specifically on that, is 12. That's taxable income. Taxable income. Not gross income, not AGI, taxable, which is income after you take your 401k distributions, your deferrals into your traditional 401k, not Roth. And secondly, after you have your AGI, your standard deduction. All right, so now we got $31,700 here. And we can go all the way up to $77,800 minus $31,700, which means we have $46,100 we can use before we go into the 22% tax bracket. Now, why is that important? Because remember what happens once you're still in the 12% tax bracket if you have capital gains or qualified dividends outside of an IRA or 401k, they have a 0% tax rate. There's no tax whatsoever. Long-term capital gains, qualified dividends, nothing. On top of that, my friends, is that once you're the 12% tax bracket, because we have a lot of wiggle room before we go to the 22% tax bracket for sure. So keep that in mind. 0% capital gains and dividends, long-term capital gains are taxed at 0 if you stay in the 12% tax bracket. Oh, that's what I was going to say. But here, I don't think they had anything really significant outside of an IRA. If they did, we might want to start thinking about things to take advantage of a 0% tax. But let's just say they don't. So they have $46,100 of wiggle room. Now the drawback is she already deferred $18,000 into her IRA, into her 401k. So essentially what we're going to be doing here is we're going to say she has, let's get a different color. I'll tell you what, let's do this. Let's just get rid of all that. I'm going to get a different color here. We're going to use, let's see, found a couple different colors here. Let's use purple. There we go. So they got $46,100 to work with. They have $500,000 in their qualified accounts. All right, so $500,000 in their qualified accounts. So let's just say we convert $46,100 into a Roth IRA. So we say now we got $46,100 into a Roth IRA. What does that do to the tax? Well, we know it's going to be taxed at 12%. Now, they live in California. I don't know what the taxes would be in California. I don't think, well, I don't know. So she'd have to look at that. But say $46,100 times 0.12. It'll cost them $5,532 in taxes to move this money to a Roth. Let's just say $6,000 for simplicity. $6,000 in tax to Roth. $6,000 in tax. All right. So a couple things happen here. Why is that beneficial? Well, because if he pays back his Social Security, which he should, he will not be subject to taxation on Social Security. That's the issue, because he has no Social Security for which to be subject to taxation on it. So now we've reduced that $500,000 in from if they're qualified accounts to roughly, what's that, $454,000. All right, so now $454,000 is remaining in their qualified accounts. So he's not going to have to take RMDs for 2 or 3 more years, all right? So 67, 68, 69, 70, 3 more years. He won't have to take RMDs. And when he decides at 70 to take Social Security, all right, he has $2,500 a month now, but that Social Security benefit is going to grow pretty substantially to about $3,200 a month when he's 70 years old. So the idea here is if she were to quit working, all right, so if she were to quit working tomorrow, again, I can't remember the cash account. If I recall correctly, she had some money in a cash account of some sort. But if she were to quit working, not tomorrow, but next year, they're not going to have any income. So theoretically, or presumably, they have enough in cash in which to cover the income they need. But frugal people don't spend a lot of money, and if their house is paid off and whatnot, they got some rental income, things of that nature. We haven't done the planning yet, but just in the back of my mind, this is my kind of thought process. We have essentially She's going to be 62 next year. All right, so we have 8 years to get all this money to a Roth. Now, so if you take 454,000, divide that by 8, that means she'll be able to put, if you can put 56,000 a year into a Roth, that'd be beneficial. Now, I'm not there yet. I don't know. We haven't run the planning. And that's what we'd have to do when we do the planning. But it starts with this year right here, because she has until December 31st now, and to get some amount of money, 46.1, into a Roth to take advantage of the 12% tax bracket. Because what's going to happen is, as I said a million times a Sunday, when he hits 70 and starts taking Social Security, without even her having an income, with his Social Security and his required distributions of, let's just say 20,000 or 15,000 bucks, I don't know what to be. Yeah, about 15, maybe, yeah, about $20,000. So now I got $20,000 of Social Security. I think she has a small pension too, small pension, and you have then you have, I'm not 20,000 Social Security. We have 2,500, 30, about 40,000 Social Security. You're gonna have $20,000 of RMDs plus a small pension. That could really negatively impact the Social Security taxes for sure, because remember what I talked about, how once you're in a certain bracket, basically in the 12% tax range, once you have Social Security income, your Social Security any tax that you get will add not only to your income tax, but make your Social Security taxes. So every dollar of income that you pull from an IRA is not a dollar going to your bottom line. $1.85 is going to your bottom line because of income tax plus tax on Social Security. Essentially, you can't find a deeper, a more tragic double taxation than when you're in this 12, basically right here. This tax bracket is right there. Not much income, Social Security, RMDs, and then you're gonna have to pay taxes on your income from your RMD, and then it'll increase your Social Security taxes. So again, $1 of income equals $1.85 in taxable income, which is horrific. I've done tons of videos on that. I won't get too much into it now. But here's what we're looking at today, year-end tax planning. We got 31,700 as taxable income. It'd be insane not to take advantage of the 12% bracket, insane. Should she do the whole 46.1? It's up to her. She wants to pay $6,000 in income tax, and absolutely. If she's okay with that, absolutely. If she's not okay with that, well, don't. We can do 25,000. But in my mind's eye, and this is what I told you yesterday, I said, man, you got about $500,000 in your qualified accounts. When you don't work anymore next year, you're going to have no income because your husband's repaid his Social Security, all right? You have no income next year whatsoever because he's repaid his Social Security. So in that case, man, we need to start really moving money from your qualified accounts to your IRA to take advantage of that. You got no earned income, no income whatsoever. And I think she said, again, a small monthly pension. But then we got, I mean, shoot, by that case, by next year, because you'll have no income, in the 19,500 is a taxable income to be in the 10%, 19,500 plus another 25,300. Bear with me just a second. 19,500 plus 25,300. You'll have 44,800 of AGI before they're in the 12% tax bracket. So let's just say next year now they got no income whatsoever. They're just living on their money in the checking account. They got 44,800 in which they can pull from this traditional IRA into the Roth and to stay at that 10% bracket. I don't think it's that big of a deal to go from 10 to 12, but if you want to, you can. You can say, we're going to take a check for $44,800. Not a check. We're going to take $44,800, move from our traditional to our Roth, and that will all be subject to 10% tax because there's no tax bracket. No, we're not in the 12% tax bracket until we go above the 44,800 in AGI. So tax planning, my friends, this is tax planning 101. So what you need to do, let's just write on the board here. You need to get a gauge. Oh man, that thing broke. That's why it's doing that. I gotta redo that one. I was wondering why I keep bouncing around like that. Oh, all right, have to fix that. All right, and that's why you have an impact drill, so you can just quickly undo that. All right, so what we need to do, what is by year end? What is your AGI going to be? Do not wait until next year because next year is too late. You can't do Roth conversions in next year for this year. It doesn't work like that. So find out. Just look at your 1040. Has anything changed from last year? Look at your 1040. You get a pretty good gauge right there with your AGI. Line 37 on the first page. That is your AGI. Then you say, okay, so let's just say our AGI is I don't know, $85,000. And this is last year, and presumably it's the same thing. How many exemptions, deductions do we have? I guess there's really no more exemptions, but how many deductions do we have? Remember, if you're married filing jointly under the age of 65, it's $24,000. If you're married filing jointly above the age of 65, it's $13,300 per person who's above the 65. If you're single over 65, I think it's $13,600. If you're single under 65, it's $12,000. So just know that. So we have deductions. And you are going to do some guesstimating. There's no other way around that. And I don't know, $12,000. We'll just say you're single and deductions $12,000. Your taxable income then is what? $73,000. Is there opportunity there to move some money over? I mean, in that case, maybe not, because you're single. You're already in a pretty high tax bracket, 22%. And you're probably looking at going to 24%. It really depends on how much you have in an IRA, because if this is the lowest tax bracket you're ever going to be, when you think about Social Security, how much that's taxed plus your required minimum distributions, then you probably don't want to do much. But either way, you need to know your AGI, how many deductions you have, and then you take those two and what's your standard and what's your taxable income. If you are not in a position where you're not in the lowest tax bracket you ever be, if you're in the lowest tax bracket you ever be, you certainly want to be moving money, absolutely, without question, like the first lady, Jane and Bob, because they are never going to be in that tax bracket again, most likely, because they're going to have Social Security for both Jane and Bob, pensions, IRA, mandatory distributions, the whole thing. So they're going to be paying a whole lot more taxes in the future than they are today, certainly next year. So it's worth taking a risk to start moving money to a Roth by year end. You need to look at the same thing. Now, it might not work. It might say, I don't want to be, I'm going to highest tax bracket today, I'm going to be much lower in the future. Then don't do it, for sure. But make sure you understand the consequence of not doing it. You can't just look at taxes today versus tax in the future. Taxes today versus taxes in the future, plus taxes on Social Security, plus taxes on dividends and capital gains, plus higher Medicare premiums. You got to look at all that, plus net investment income tax. You got to look at all this stuff. You can't just say taxes to taxes. But if you're in a 33% tax bracket today and you think you're only going to be in a 12% tax bracket in the future, well, it doesn't make sense to do any Roth conversions. On the other hand, if you're in a 12% tax bracket today and you could easily see yourself in a 22% tax bracket in the future, take advantage of the 12% tax bracket today and start moving money ASAP. Absolutely get that done by year end. Look at last year's 1040. If you need to, look at last year's W-2. You need to be doing preemptive tax planning today. And we haven't even talked about tax loss harvesting, the whole thing. Just looking at your income statement. Look at your income statement, then your balance sheet. How much do you have in qualified accounts? Is it worth it to start moving money over? And in her case, the answer is absolutely. All right, don't forget to subscribe, comments, thumbs up always help me. Go to the blog at Heritage Wealth Planning, and we'll see you next time for part 2 on our year-end tax planning. See you later. Bye-bye.